Here's a question for you. How much money do you think you really need to live off dividends? $1 million? $500,000? What if I told you that you could start with a lot less than that? Say just $200,000? Sounds impossible, right? Well, stick with me, because today, we're diving into how you can make that dream a reality. Whether you're looking to retire early or simply create a passive income stream, living off dividends is more achievable than you might think. In this video, we'll break down the basics of dividends, how much you need to invest to start living off them, and the power of reinvesting your dividends to grow your income over time. We'll also talk about how to build a diversified dividend portfolio, avoid common pitfalls like chasing high yields, and even touch on the tax implications of your dividend income. By the end, you'll have a clear roadmap to start generating reliable income from dividends, even with a modest investment. And trust me, it's simpler than it sounds. But first, let's break it down. What are dividends, and how can they help you achieve financial independence with a relatively low amount? All right, let's start with the basics. What exactly is a dividend? Simply put, a dividend is a portion of a company's profits that gets paid out to shareholders. Think of it as a reward for owning a piece of the company. If a company does well, they might decide to share some of those profits with you, the shareholder, in the form of a dividend. Now here's where it gets interesting. Some companies pay dividends regularly, like clockwork, quarterly, monthly, or even annually. If you own enough shares in these companies, you could potentially cover your expenses with the dividend income alone. It's like owning a rental property, but without the hassle of tenants or maintenance. But before we dive into the how-to, let's address a crucial question. Is it really possible to live off dividends with as little as $200,000? The answer is yes, if you're smart about it. And I'm going to show you how. Let's talk numbers. How much do you really need to start living off dividends? Spoiler alert, it's probably less than you think. But like any good plan, it starts with a clear goal. Imagine this. You want to replace your current income with dividend income. Let's say you're aiming for $20,000 a year, a modest but achievable goal. To hit that target, you'd need to figure out how much to invest and what kind of returns you can expect. Here's a simple formula. Desired annual income divided by dividend yield equals the amount you need to invest. For example, if the average dividend yield is 5% and you want $20,000 per year, you'd need to invest $400,000. But what if you could find stocks with higher yields or combine dividend income with other strategies? Suddenly that target doesn't seem so far off, does it? Now, let's say you start with $200,000 instead. With careful planning and reinvesting your dividends, you could potentially grow that income over time, turning your $20,000 goal into a reality. This is where the power of reinvesting dividends comes into play, and it's a game changer. Reinvesting dividends is like giving your money a growth hormone. Instead of spending your dividends, you use them to buy more shares, which in turn generate even more dividends. It's like a snowball rolling down a hill, gathering more snow and speed as it goes. Let's take a real-world example. Say you invest $200,000 in a diversified portfolio with an average yield of 5%. That's $10,000 in dividends in the first year. If you reinvest those dividends, buying more shares, your investment grows. Not just from the stock price appreciation, but from the increasing amount of dividends as well. Over time, this compound effect can be incredibly powerful. In fact, it's one of the key reasons why long-term investors often outperform those looking for quick gains. So, when should you start reinvesting dividends? The sooner the better. But don't just take my word for it. Let's look at some historical data. Historically, companies that pay consistent dividends tend to be more stable and less volatile than their non-dividend paying counterparts. This isn't just a coincidence. Companies that pay dividends are often more mature, with steady cash flows and a proven track record. According to a study by Ned Davis Research, dividend-paying stocks have significantly outperformed non-dividend-paying stocks over the long term. From 1972 to 2018, dividend growers and initiators, companies that started or increased their dividends, produced an annualized return of 12.9%, compared to just 8.6% for the broader market. But it's not just about picking any dividend stock. You want to focus on quality, companies with a strong history of paying and increasing dividends. These are often referred to as dividend aristocrats. So, what makes a dividend aristocrat, and why should you care? A dividend aristocrat is a company that has not only paid, but also increased its dividend for at least 25 consecutive years. These companies are the royalty of the dividend world, reliable, consistent, and committed to sharing profits with shareholders. Think about it. To increase dividends for 25 years straight, a company has to navigate through all kinds of economic conditions, recessions, market crashes, you name it. These companies have proven their resilience and their ability to generate profits year after year. Some well-known dividend aristocrats include Coca-Cola, Johnson & Johnson, and Procter & Gamble. These are companies that have been around for decades, with strong brand recognition and steady demand for their products. But don't just go buying any stock with a high yield. High yield doesn't always mean high quality. Sometimes, a stock's yield is high because its price has dropped significantly, which could be a red flag. Instead, focus on the dividend payout ratio, a key metric that can help you assess a company's dividend sustainability. The dividend payout ratio tells you what percentage of a company's earnings are being paid out as dividends. It's calculated by dividing the dividend per share by the earnings per share. A lower payout ratio generally indicates that the company has plenty of room to maintain or even increase dividends in the future. A payout ratio of 30 to 50% is often considered healthy. This means the company is paying out a reasonable portion of its profits as dividends while retaining enough to reinvest in growth. But if you see a payout ratio above 80% or even 100%, that's a potential warning sign. It might indicate that the company is stretching its finances to maintain its dividend, which could be unsustainable in the long run. So, now that we've covered what to look for in a dividend stock, let's talk about building your dividend portfolio. How many stocks should you own, and how do you diversify? Diversification is the secret sauce to any successful investment strategy, and dividends are no exception. By spreading your investments across different sectors and industries, you reduce your risk. If one company or sector underperforms, your other investments can help cushion the blow. Think of it like this. You wouldn't bet all your chips on one number in roulette, right? The same principle applies to investing. Diversifying your portfolio is like covering multiple numbers on the roulette wheel, increasing your chances of a positive return. A well-diversified dividend portfolio might include stocks from sectors like consumer goods, healthcare, utilities, and technology. Each of these sectors has different drivers, so they're less likely to all underperform at the same time. Now, you might be wondering, how many stocks should you hold? While there's no magic number, holding 20 to 30 different dividend stocks across various sectors is a good starting point. This gives you a nice balance between diversification and manageability. Now, let's talk about something that might surprise you. Taxes. Yes, even your dividend income is subject to taxes, but don't worry, there are ways to minimize the impact. Qualified dividends, those paid by U.S. companies or qualifying foreign companies, are taxed at a lower rate than ordinary income, typically between 0% and 20%, depending on your tax bracket. This is a huge advantage compared to regular income, which can be taxed at rates as high as 37%. But what if you're investing through a retirement account like an IRA or 401k? In that case, your dividends can grow tax-deferred, or even tax-free if you're using a Roth IRA. This means more of your money stays invested and compounds over time, accelerating your path to living off dividends. So, where do you go from here? How do you start building your own dividend portfolio today? First, determine your income goal. How much do you want to earn in dividends each year? Whether it's $10,000, $20,000, or more, having a clear target will help guide your investment strategy. Next, start researching dividend stocks that align with your goals. Look for companies with a history of paying and increasing dividends, a healthy payout ratio, and strong fundamentals. Remember, patience is key. Building a dividend portfolio is a marathon, not a sprint. And don't forget the power of reinvesting your dividends. The more you reinvest, the faster your portfolio and your income will grow. Finally, consider automating your investments. Many brokerage accounts offer dividend reinvestment plans, trips, and automatic investment options. This takes the guesswork out of investing and ensures you're consistently adding to your portfolio. And remember, you don't need to be a millionaire to start living off dividends. All you need is a plan and the commitment to see it through. Now that you know how accessible it can be to start living comfortably off dividends, there's one more secret strategy you'll definitely want to explore: the 8-4-3 rule. This little-known method is a favorite among top investors for potentially tripling their earnings within just 12 years. Most people don't talk about it, but don't worry. We have that one covered in this video if you want to check it out next.